So I'm Shona Campbell. I am a partner at Henderson Loggie, and my area of specialism is business recovery and insolvency. And I am an actual insolvency practitioner. So as well as giving advice on recovery options and distress, I also act as a formal insolvency practitioner in respective liquidations or administrations or receivership. So I spend about half my time giving advice to clients in distress, often very many charities. And in fact, that's why this seminar came into being, because EVOC was aware of a couple of charities that I had given advice to that had been really valuable for those charities who were a bit sort of like, we've got some problems, we don't know what to do. And I was able to talk them through some of those options. And happy to say that the two charities I spoke to, neither of them are in a formal insolvency process, and they're still continuing to trade and meet their charitable purposes. So a quick run through of what we're going to cover today: some warning signs of distress, questions to get answers to. So that's when you're sitting in the trustee meeting and you're not quite sure, the numbers. What do I need to ask? What do I need to know? I'm going to speak about the importance of forecasting and monitoring cash flow. That was something that had come up. Some of the comments about people, what they wanted to get out of today. So we didn't touch on the cash flow. Then we look at, okay, if there is distress there, what are some of the options you might want to think about? Question that comes up all the time with trustees is, if a charity that they're a trustee of goes into an insolvency process, what is the impact on them personally? Are they personally liable? Are there longer term consequences of that might impact them? So I'm just going to touch on that, and then we're going to do some discussions and wrap up. So and I think as well, just going back to the reason why this seminar came up was because the charity sector in Scotland is facing an exceptionally difficult environment, and there is a lot of problems with many charities around their sustainability of their financials. I could spend a whole 90 minutes speaking about all the issues that you're all facing. You're all a good old whinge about how difficult the environment is, but you've got rising costs, funding cuts, increased demand for service, and you've got donor fatigue, reduced public sector support, increased regulatory pressures, all these new regulations that Keith's just spoken about. So it's a difficult environment, and that means in a challenging climate, you need to have strong financial management. You need to have proactive engagement with your stakeholders, and you need to understand what the options are when things aren't right. Charities need to be adaptable, seek collaborative opportunities, and take early action. And if there's one thing that you're going to take away from my part of this session, it's about early action, and it's about getting early advice. If there is distress, the sooner you do something about it, or the sooner you take advice, the more likely that you're going to come out the other side. So warning signs of distress first up. So a nice red flag there. So firstly, lack of, so this is you're a trustee of a charity, you're not involved in the day-to-day running. You turn up at your board meeting, and these are some of the things that you might be thinking about. Right, okay, we need to drill down a little bit here. There maybe, and the more of these things that you can say yes to, the more likely that there's going to be big problems. So lack of reliable financial information. So charities need to, as Keith's just been telling us, keep up to date and accurate financial records, and poor record keeping. That can lead to cash flow issues, misreporting to the trustees, and potential regulatory breaches. So trustees need to have clear, timely financial reports so they can make proper decisions. So you should be having, there should be management accounts regularly presented at meetings. There should be proper accounting records, there should be a proper accounting system used, and strong internal controls. The second is increasing creditor arrears. So again, this can be something you can ask added to management information if it's not there. What is the level of the creditor's balance? How many days supply does that represent? And the increasing trend, unless it can't be explained by another reason, that's something to be worry about. And what I'll say in a lot of the charities that I end up getting involved in with formal insolvency appointments as a liquidator, there's quite often a significant HMRC balance for PYE, NIC, where there's a lot of employees. And that's, you need to pay your employees for them to turn up. You need to pay your landlord or he's going to chuck you out. If you're buying supplies, you need to buy the supplies and pay for them. HMRC, it's easier not to pay them because you would deduct the tax from your employee's payroll and don't pay it across. And they take a wee while to come chasing, but they will. And then once they come chasing, that's when you're down to very limited options about what you can do. Another thing I see quite often is in creditors taking legal action, be that HMRC or somebody else, and that's where if the charity is getting red letters, demands for payment, that sort of thing, that's not a good sign. So the loss-making trading subsidiary. Again, this is something I quite often see in the charities that I get appointed over, and what happens is you've got the charity itself. You have the trustees on the board of the charity doing the charitable purposes, and then there will be at some point a trading subsidiary set up, and that trading subsidiary just sort of does its own thing, and the charity trustees maybe don't ask the same questions about the trading subsidiary. If the charity is supporting that trading subsidiary and giving it money, there will actually be an asset that sits on the balance sheet. So there might not be anything to be paid back from, there might not be any money sitting in that subsidiary, and it may just be that the charity is funding it again. So it's just something to watch for if you're on a board of a charity that has a trading subsidiary. Ask to see the accounts of the trading subsidiary and get a bit more information about what is that, and is there actually a risk there. Unreconciled bank statements. So I think I read some Oscar guidance recently that said that trustees should be seeing bank statements that are reconciled on a regular basis. So just ask to see them. And what's the difference between an unreconciled bank account and a reconciled bank account? Why is it important? When you get your management accounts and it says there's £100,000 in the bank and you think that's great, if that's not reconciled, you have no idea what the actual bank balance is, and it might be nothing like that. And again, that is something I've seen in a few of the insolvencies that I've been involved in, where accounts haven't been. It goes back to that reliable financial information, poor record keeping. Is if the bank statements aren't regularly reconciled, and nobody really knows how much money's in the bank account. Next one is red flag. I mean, it might be completely innocent, but when you see finance and key staff leaving, is it because they're stressed out at work and they can't cope with it? And just that whole people leaving, people starting, sometimes things fall between stools, and there's just that, frequent turnover staff can indicate underlying issues, or indeed cause underlying issues, or create new issues through that lack of institutional knowledge, and again, just weakness. Asset rich, cash poor. So again, this comes back to, we'll move on in a moment to speak about actually what insolvency is, but this is about where you've got, the balance sheet has millions and millions of pounds in it, millions, and it's all property and all, we've got such a fantastically strong balance sheet. If it's not cash and the wages are due at the end of the month and you don't have any money to pay the wages, it doesn't matter how many assets you've got. If you can't get the cash quickly to pay your wages, you're effectively going to have to stop trading. Another thing that can often sort of catch charities out, in fact, any business, is not engaging with key creditors. And again, this has been a couple of insolvencies over time, specifically with charities, where they have had, in both cases, there was a property they'd occupied for a very long period of time. They'd moved out of the property and they'd had a big dilapidations bill. Land, so that's when you move out a lease at the end of a period, the landlord can make a charge that effectively is to make the property good again as to what it was. So you get a dilapidations bill of tens of thousands of pounds, and the charity trustees had a sort of conversation with somebody at the landlord at some point and said, don't worry, it will be fine. However, some legal letters started arriving and the charity were like, well, it's all right because we were told that it was going to be fine. They're never going to wind us up. We're a charity. People don't wind up charities. But yeah, you can guess what happened. The landlord were like, we want this money. You're not engaging with us. So, any opportunity that there was to have a negotiation, reduce the amount, plead their case, had gone, and yeah, when you don't engage, you just end up at the end with yeah, an unexpected insolvency. So moving on, so that's some of the red flags to watch out for. But I thought it might also, and we will circulate this round afterwards, but if you're, I suppose it's, well, what is insolvency, right? What is financial distress? And financial distress is effectively the stage before you become insolvent. Insolvency is acute distress. What is insolvency? There's two definitions of insolvency, okay? The first one is when your assets are less than your liabilities. And that's what's called balance sheet insolvency. Now, still insolvency, but the key one is the inability to pay your debts as and when they fall due. So this is all about, and this is where we're going to touch on the cash flow, but cash is king, and you can't underestimate the importance of cash. You can have, like I said, you can have tens of thousands of pounds, millions of pounds worth of property, investments. If those investments are locked up and you've got urgent bills that need to be paid and you can't do it, you're insolvent. And the thing about insolvency as well, it's quite easy to look back in hindsight and say, "Oh yeah, we were insolvent then." But when you're actually in the whirlwind of it all, maybe there are some creditor arrears, but maybe you've still got lots of cash in the bank. Maybe one creditor has served a charge. However, you're completely up to date with your HMRC. It's just there's questions here, and basically the more red flags or the more and these questions here, depending on the answers, more yeses, the more likely it is that you've got a problem, the more likely it is that you're insolvent. Key thing, take advice. Quite often I hear people say, well, we're not going to take advice because we can't afford it. And we don't want to, turn up at my office or a solicitor's office and end up being charged, £300 an hour when you don't have the cash to do that. Certainly most insolvency practitioners in Scotland will give initial free consultation, and I think even if there is limited funds, paying for legal professional advice at a point where you are really concerned about the solvency position of your company, no one is going to criticise charity trustees for taking that advice and paying for it. So list there to get some of the balance sheet. Are the current assets plus investments less than the current liabilities? What's the total assets and foreseeable income less the total liabilities and expected expenditure? So a cash flow would help you with that one. Are you using your reserves? So Keith was speaking a lot about reserves there. Are reserves being used to fund your day-to-day trading? Are you using the restricted funds for that? Some more questions. Are you relying on bank loans with unclear renewal or extension options? So the risk there is that the bank can demand repayment if there's not the clear terms. Pressure for creditors. Does the charity have potential significant contingent liabilities? So that might be exactly like you move out of your lease and you've got a dilapidations bill owed to the landlord. And then cash flow. Does the cash flow show that there are insufficient monies to make all payments as and when due? So the importance of forecasting and monitoring cash flow. And I think I've already made this point, and I may make it again, but charities fail not because they run out of funds on paper, but because they run out of cash on real life. Cash flow forecasting is essential. And that's not just for if you think things might be getting a bit tricky. It allows you to plan ahead. It allows trustees to make proper decisions. It prevents financial distress, early warning signs. Also reassures your stakeholders, whoever they may be, but funders, donors, lenders, if you have them. All very, very important. And practical steps for effective cash flow forecasting. To create a rolling 12-month cash flow forecast, that's what you need to do. 12 months, and I would say 13 weeks in distress, because 12 months is probably too long. But you got income, expenditure, identify what your key income and expense trends are, build a cash reserve as much as you can. We speak about reserves. different policy depending on your charity, but typically you're looking at 3 months, 6 months, something like that. Improved payment and income timing, and what this comes down to is like, can you get your funders to pay you by chaps, backs, direct debits on their end rather than checks. And likewise for your your payments out, you want them to be automated as much as possible just to make it efficient. You need to regularly update your cash flow as well, because you need to be able to monitor and react quickly. And quite often I'll be recently, in the last 6 months or so, I've given advice to quite a lot of charities who've never been in the circumstance before when they sort of do their cash flow forward at the start of the year. They're sort of doing their projections, and they're looking ahead for the 12 months, and they're realizing that actually they don't have enough cash, and they're going to run out of cash at month 6, month 9. And it's all about, well, does that mean we're insolvent? And it's like, well, with a charity, again, there's lots of different factors, but what you need to be thinking about is what other potential income are we going to get in? How many grants have we applied for? Where can we cut our costs? And that's all about that cash flow, and having that cash flow tool allows you to identify these cash shortages a long time in advance, and then take steps to adjust it and take action so that you don't end up in the position where you do run out of cash at the end of the month when the wages are due. Again, it's always when the wages are due is when I get the call, and like, well, there's not very much I can do now. Okay, so what are your options? And again, professional advice, early advice, more options. Key takeaway number 1 from today. Key takeaway number 2 would be the asset rich, cash poor. You run out of cash, and that's what causes you problems. So quite often it might be a mix of one or more of these things: obtaining new funding, a funding drive, amendments to existing financial commitments to facilities. If there's a long-term loan there, can that be extended out over a longer period? Engagement with stakeholders for assistance, whoever those stakeholders might be. Is it a landlord? Is it a local council? Is it government? Is it a key customer? Just review of all your expenditure, reviewing your service provision, realisation of surplus assets, mergers with other charities, organisations. I think if you're sort of looking at a point where actually we are not able to merge, we're not able to generate enough income to cover our costs over the longer term, are you actually thinking about taking the decision to cease trade and wind up the charity now, whilst there is still sufficient money to pay off all your creditors in full, and then end up with a pot of cash that can be obviously under OSCR, it needs to go to another charity as set out in your constitution, or indeed with similar charitable purposes, and actually is that the best thing to be done? You should avoid so you make arrangement with creditors, and that's effectively, we're going to pay you up over a longer period of time. Avoid taking on new debts. You might voluntarily enter into a formal insolvency process, or you might do nothing, and that's the ostrich with the head in the sand there. And I think the worst thing that you could do is nothing, because, well, yeah, there are maybe you will suddenly get a £1 million donation from tomorrow from somebody, but realistically, that's not going to happen. So what not to do, and this is with a particular eye on, if a charity that is a company becomes insolvent, then the insolvency practitioner that's appointed will look at the conduct of the directors, and either decide that the insolvency practitioner might actually take action against something that a director has done, or alternatively, will make a report to the insolvency service, which is part of the government, and the report there, if there's been sufficient conduct as deemed bad enough by the insolvency service, they may look to disqualify a director. And we'll talk a little bit more about that shortly. But mismanagement of company finances, failure to maintain proper records, similar to some of the responsibilities under Keith, but there's a few more that you need to think about when you're looking at insolvency, and that's preferential transactions. So did you pay one creditor and not another creditor? Giving away assets for less than they're worth. You have to give them away for value, particularly not to connected parties. So if there is another charity that does the same thing that your charity does, and you want to give them away an asset because they'll be able to make use of it. If it's insolvent, you can't do that. You have to realise it for value within the charity as it is, for the benefit of that charity's creditors. So again, failing to comply with legal duties, fraudulent activities, or misconduct, so very, very general. So moving on to the position of personal liability. The personal liability position of a charity trustee, if the charity enters insolvency, depends on the type of charity that it is. So you have in Scotland sort of four main charitable types of organisations. You've got the limited company, where in general there is no personal liability of trustees except for some circumstances which we'll talk about in a minute. SCIO, which Scottish Incorporated Charitable Trust, limited liability, so similar to the company's position. You've got society and membership benefit cooperative societies. They're a membership society, but the personal liability of the members is limited also. And then the final type of charity is an unincorporated trust. So that's the one that's got the key difference there is there's no limited liability. So that means that if the unincorporated charitable trust has more liabilities and assets and it is wound up, the creditors can have a call against the trustees personally, so can pursue the trustees personally, which is why, if you've got a unincorporated trust, if that's your type of charity, you need to be mindful of that. There are things that can be done, but again, that's about professional advice. But generally, in a company, in the cooperative society, the position is that you've got that personal liability unless if you give a personal guarantee for anything, and then the second potential is if you have done something, given away an asset for less than it's worth, if you have preferred one creditor over another. If you continue to rack up liabilities knowing that you're not going to be able to pay them, other things like if you've taken excessive benefits out, then there is a route for an insolvency practitioner, a liquidator, or an administrator to go against you personally to get them back. So that's it. It's all but generally, if you've been doing anything proper, and making, taking professional advice, taking care of your duties, taking early advice, and acting on it, then the risk of personal liability is limited in those situations. In terms of other implications, when a charity enters insolvency, again, it depends on the type, but in general, there's no real implication. You can still be a trustee of other charities, you can still be a director, you can still be a member of parliament if that's what floats your boat. All those things you can still do. It should not affect your personal credit rating. You should be able to get credit, unless you've been a bit naughty, and let's say the insolvency service either decide to disqualify you as a director, or the insolvency practitioner is pursuing you personally for payment, and you don't pay. The subsequent outcome might be that the insolvency practitioner will actually petition for bankruptcy, to ensure they get the money back from you. But it's there. It could happen, but it's very much depends on what the behaviour has been. So, right, questions and wrap up.